In Chapter 34, our discussion covers sole proprietorships and partnerships. But before we start, consider that we're moving into business entities as a topic, as a large subject indeed, not just in one chapter. And in that vein, please think of all the entities or forms of businesses that you would think of to create as vehicles that would carry you. In other words, your business entity is a vehicle that carries your business. You choose the entity based upon how you consider 1, taxation, 2, tort liability, 3, contract liability, 4, premises ownership liability, and 5, distribution of proceeds, dividends, and 6, just a general catch-all. A major advantage, though, in forming either a sole proprietorship or partnership is the ease of its formation. To create these, you just start. Most of the states have adopted uniform partnership agreement laws that provides for such simplicity. If you are engaged in a partnership behavior, even if it's not a clear or spoken partnership arrangement, there is still a partnership. For example, if you and your uncle opened up a contracting business, the business bought a truck, but at the end of that partnership, that is winding up the partnership, that truck wouldn't be yours or your uncle's. It would belong to the partnership, and the proceeds of its sale would then be split up per the partnership established split of responsibility, even if neither of you had agreed to such arrangement. Thus, the partnerships are automatic based upon how the parties behave, and not so much what they agreed to or did not agree to. So the wonderful thing about a partnership is that under the Uniform Partnership Agreement Acts, the law spells out how partnerships can exist under either oral or written agreements. For sole proprietorships and partnerships, though, there is one important consideration. The tax consideration is considerable. The owner, who is a sole proprietor, for instance, receives income taxed at that individual's income levels. It's taxed, in other words, proportionally to that owner's income. Thus, if the owner realizes an unexpected income during a fiscal year, that owner can't control how then she is taxed. In other words, the tax brackets and rates are fixed. Thus, the tax is unpredictable, as was the income. The same is true for partnerships. The partnership itself doesn't pay a tax. It is a pass-through vehicle so that income that it receives is attributed to the partners per their distribution agreement. Consider that at the end of the fiscal period for a partnership, which actually is the same as the individual, that is, the calendar year of January 1 through December 31, consider the general partners must then zero out all partnership income. They must either make legitimate business expenses, such as paper supplies or building expenses or others, because at the end of the year, money left over in the partnership account is money, according to the IRS, that's attributed to those partners, both of them, based upon their partnership share, even if in fact they have not received that money personally, and it remains in the partnership's coffers. Thus, these two entities, partnerships and sole proprietorships, have negative tax aspects. They can't control how much tax they pay. Partners may agree to take more money than other partners before the fiscal year ends in order to organize which partner incurs greater or lesser tax liabilities. And generally speaking, that money that they take is then money paid back in future fiscal years. But other than that, there's very little that the partnership or sole proprietor can do to plan for tax liability.